The money was supposed to be there. Customers believed it was sitting safely, waiting behind a login and a password. Instead, in early November, withdrawals froze. Screens refreshed. Nothing moved. Billions of dollars vanished in real time. Inside the crypto world, whispers turned into panic. A balance sheet leaked. Holes appeared where certainty had been. The most trusted exchange in the market was suddenly begging for help it could not secure. Phones rang without answers. Executives stopped posting. Confidence collapsed faster than prices. At the center stood Sam Bankman-Fried, a founder who had sold himself as careful, ethical, and different from the chaos around him. He talked about math, risk control, and doing good with money. He had been invited into rooms regulators rarely opened. Now investigators were racing the clock, trying to understand whether this was a sudden failure or something far darker. Because if customer funds had been used, moved, or lost long before the panic, the collapse was not an accident. It was the end of a story that had already been written. 1. The trust machine. FTX did not sell itself as a gamble, it sold itself as infrastructure. On the surface, it looked nothing like the shadowy exchanges that had already collapsed across the crypto landscape. It spoke the language of institutions. Speed, liquidity, risk management, compliance, at least in spirit. Its marketing promised reliability in a market built on volatility. Customers were not told to get rich overnight. They were told their money was safe. By 2021, crypto had entered its second act. The early chaos had given way to venture capital, celebrity endorsements, and televised debates about regulation. Retail investors poured in. So did hedge funds, pension-linked vehicles, and global trading firms looking for yield. FTX positioned itself as the bridge between that old world and the new one. The company was headquartered offshore, based in the Bahamas, outside direct United States banking regulation. But it courted American influence aggressively. Its founder, Sam Bankman-Fried, testified before Congress. He spoke in measured tones about consumer protection. He warned lawmakers that crypto needed guardrails before the wrong actors caused real harm. That framing mattered. It separated FTX from its peers. Bankman-Fried did not look like a typical financial executive. He wore shorts and wrinkled shirts. He spoke quickly, sometimes awkwardly, leaning on probability theory and utilitarian ethics. He presented himself as a numbers-first thinker who cared less about wealth than about outcomes. He claimed his goal was not personal enrichment. It was effective altruism. Make as much money as possible, then give it away to causes that saved lives or reduced global risk. For an industry accused of excess, it was a powerful narrative. Behind that narrative was speed. FTX grew at a pace that made traditional firms uncomfortable. New products launched in weeks, not months. Complex derivatives were offered to retail users around the world. Leverage was high. Liquidations were fast. The platform rarely went down. Traders loved it. So did venture capital. High-profile firms invested at soaring valuations. Celebrities appeared in ads. Stadium naming rights were secured. Political donations flowed to both major parties in the United States, buying access if not influence. All of it reinforced the same message. This exchange was different. This exchange was serious. At the center of the operation was a tight inner circle. Decision-making power was concentrated. Internal documentation was sparse. Many processes ran through informal chats and ad hoc approvals rather than written policy. That was not obvious from the outside. What was visible was the relationship between FTX and Alameda Research. Alameda was a crypto trading firm founded by Bankman-Fried before FTX existed. Publicly, it was described as a separate company, an early market maker, a liquidity provider. The connection was disclosed but downplayed. FTX executives described Alameda as just another client, subject to the same rules as everyone else. They insisted there were firewalls. They assured users that no special treatment existed. In crypto, those assurances were often taken on faith. Few customers read terms line by line. Fewer understood the plumbing beneath the interface. They saw an exchange that worked. They saw fast fills and deep liquidity. They saw a founder welcomed by regulators and praised in the press. Trust became the product. That trust expanded rapidly during the bull market of 2021. Bitcoin climbed. So did everything built on top of it. Tokens launched daily. Venture deals closed weekly. Paper wealth multiplied. Rode the surge. Customer deposits ballooned. The exchange handled billions in daily volume. It expanded globally, offering services to users in dozens of countries. Its risk engine was marketed as superior, its liquidation system as more humane. Internally, the same speed that powered growth also hollowed structure. The company had no traditional board in the early years. Oversight was limited. Financial controls were loose by institutional standards. Critical roles overlapped. A small group of executives held keys to enormous sums of money. That alone was not illegal. In crypto, it was common. What mattered was how that power would be used when markets turned. Warnings existed, though faint and scattered. Some industry insiders questioned how Alameda consistently outperformed rivals. Others noted that FTX offered unusually generous terms to large traders. A few raised concerns about leverage and interconnectedness across the crypto ecosystem. Those concerns did not gain traction. As long as prices rose, the machine appeared stable. FTX's public posture reinforced calm. Bankman-Fried spoke frequently about risk management. He framed himself as a responsible actor trying to clean up a reckless industry. He criticized decentralized platforms as dangerous. He pushed for regulation that would favor centralized exchanges like his own. The message to users was clear. Chaos was everywhere else. Here there was order. But order requires separation. Customer funds must remain customer funds. Trading firms must bear their own losses. Exchanges must not act as banks, brokers, and hedge funds at the same time. Those lines were assumed to exist. By early 2022, the broader crypto market began to crack. A major algorithmic stablecoin collapsed, wiping out tens of billions in value. Hedge funds failed. Lending platforms froze withdrawals. FTX presented itself as a rescuer. Bankman-Fried offered bailout loans to distressed firms. He spoke about preventing contagion. He compared himself to a lender of last resort. The media amplified the narrative. He was portrayed as the adult in the room. Few asked where the money came from. Behind the scenes, stress was building. Crypto prices continued to slide, liquidity thinned, leverage became harder to maintain. Firms that had borrowed heavily against volatile assets faced margin pressure. In this environment, any hidden weakness would be exposed. Customers still believed their deposits were untouched. They believed the exchange was merely a marketplace, a neutral venue. They did not see internal balance sheets. They did not know how closely intertwined FTX and Alameda truly were. They did not know how risk was being absorbed, shifted, or delayed. They only knew the interface still worked. Trust once established decays slowly at first, then all at once. By the time cracks became visible to the public, the question was no longer whether FTX had been mismanaged. It was whether the structure itself had been a facade, because if customer funds had been treated as a backstop rather than a boundary, the system was never stable. It was only quiet. And quiet in finance is often the most dangerous phase. The trust machine was running at full speed. No one yet knew what it was built on. Where the money went. The first sign was not an announcement, it was a document. In early November, a balance sheet tied to Alameda Research began circulating quietly among traders and analysts. It was not polished. It did not look like a public filing. It looked internal, rough, incomplete. But what it suggested was enough to unsettle anyone who understood leverage. Much of Alameda's balance sheet appeared to be built on tokens created by FTX itself. Assets were concentrated, liquidity was thin. If prices moved sharply, the math stopped working. Within hours, the document escaped private channels. Confidence cracked. Alameda had always been described as a separate trading firm. Risky, yes, but isolated. If it failed, it was supposed to fail alone. The exchange, customers were told, would be untouched. That assumption was about to be tested. As questions spread, a rival exchange publicly announced it would sell its holdings of FTX's native token. The message was brief, the impact was immediate. The token's price began to fall. In crypto, price is not just value, it is collateral. As the token dropped, alarms triggered across the system. Loans backed by that collateral moved toward liquidation thresholds. Margin requirements tightened. Pressure accelerated. Customers began to withdraw funds. At first, withdrawals processed normally. The interface still worked, transfers cleared, the system held. Then delays appeared. Support tickets went unanswered. Transaction confirmations slowed. Social media filled with screenshots of pending withdrawals. Some users reported partial fills. Others reported nothing. Inside FTX, the situation was deteriorating fast. Liquidity was draining. The exchange was facing a classic run, but without the protections of a bank. There was no central authority to backstop withdrawals. There was no insurance pool large enough to cover losses if funds were missing. Executives scrambled to assess exposure. What they found, investigators would later allege, was not a sudden hole created by panic. It was a gap that had existed long before. Customer funds, prosecutors said, had been diverted to Alameda Research over time. According to court filings, those funds were used to cover trading losses, make loans to executives, and finance high-risk bets across the crypto ecosystem. Alameda, facing mounting losses during the market downturn, had allegedly leaned on customer deposits as a source of capital. That boundary of cross changed everything. An exchange is supposed to hold customer assets in custody. It is not supposed to use them. If that rule breaks, the platform is no longer a marketplace. It becomes a lender without consent. As withdrawals surged, the math collapsed. FTX could not meet demand. The funds were not sitting idle. They were tied up, invested, or lost. The exchange halted withdrawals. The announcement was brief. Operations were paused. Users were asked to wait. Panic followed. Billions of dollars were now trapped. Customers who had treated the platform like a bank discovered it had none of a bank's safeguards. Market makers stopped trading. Partners distanced themselves. The brand that had promised stability was suddenly radioactive. Behind closed doors, executives sought rescue. Bankman-Fried reached out to competitors, investors, and industry figures. Emergency talks began. The message was urgent. FTX needed liquidity immediately or it would fail. For a brief moment, a deal appeared possible. A rival exchange announced a non-binding agreement to explore an acquisition. Markets reacted. Hope flickered. Last. After reviewing internal data, the potential buyer walked away. The hole was too large, the liabilities too uncertain, regulatory risk too high. The deal collapsed. With no savior and no liquidity, FTX filed for bankruptcy protection. The filing covered dozens of affiliated entities across multiple jurisdictions. It was one of the largest collapses in financial history. The fallout was immediate and global. Customers across continents lost access to funds. Crypto prices plunged. Firms with exposure to FTX froze operations or declared insolvency. The contagion spread through an already weakened market. Inside the bankruptcy filings, details emerged that contradicted years of public assurances. The company lacked basic accounting systems. There was no centralized ledger tracking cash. Loans to executives were undocumented. Private keys controlling billions in assets were poorly secured. A new chief executive was appointed to oversee the restructuring. He had experience cleaning up historic corporate failures. In sworn statements, he described an unprecedented breakdown of controls. The image of competence shattered. Investigators began tracing money flows. Bank records, internal messages, and transaction logs were examined. The focus was narrow and unforgiving. Were customer funds used to prop up Alameda? Were they used to cover losses? Were they used without consent? Prosecutors alleged the answer was yes. They described a system in which Alameda had special privileges on the exchange. It could maintain negative balances, it could avoid liquidation, it could access funds others could not. Those features, if proven, meant the playing field was never level. Bankman-Fried publicly denied intentional wrongdoing. He said mistakes were made. He described poor risk management. He claimed he did not realize the extent of the problem until it was too late. But the timeline mattered. If customer funds were diverted long before the run, this was not a failure caused by panic. It was a strategy that depended on prices continuing to rise. When they did not, the structure collapsed. As regulators moved in, the crypto industry confronted its own reflection. The collapse was not the result of an exotic hack or a rogue algorithm. It was a familiar story of leverage, opacity, and trust abused. The difference was scale. FTX had presented itself as the answer to crypto's credibility problem. It had argued that centralized platforms with strong leadership were safer than decentralized alternatives. Now it was the example critics would cite. The question shifted from how this happened to how long it had been happening, and whether anyone outside the inner circle truly understood the risks they were taking. As bankruptcy proceedings advanced and investigations deepened, one fact was clear. The crisis was no longer about saving an exchange. It was about determining whether the collapse was the unavoidable result of a volatile market or the predictable outcome of moving other people's money into places it was never meant to go. The run had exposed the weakness. The records would decide the truth. Chapter 3. Reckoning without a rule book. The collapse did not end the story, it froze it in place. Once FTX entered bankruptcy, the questions hardened. They were no longer whispered by traders or debated on social media. They were formal, written, signed, delivered by federal investigators who did not care about narratives or intent, only evidence. What had been marketed as innovation was now examined as conduct. Within weeks, criminal investigations accelerated. Subpoenas went out, phones were seized, digital records were preserved. What had once been private chats and internal spreadsheets became potential exhibits. The focus narrowed quickly. Investigators separated what could be proven from what had merely been claimed. They traced customer funds. They followed transaction paths. They compared public statements to internal reality. The story that emerged was not built on a single moment. It was built on accumulation. Prosecutors alleged that customer deposits had been treated as available capital, that Alameda Research had been allowed to draw on those funds through special access embedded in the exchange's systems, that losses were covered quietly without disclosure, while public assurances continued. Each allegation required proof. That proof came in pieces. Internal messages showed awareness of risk. Code changes demonstrated privilege. Bank records revealed movement of money inconsistent with customer custody. Testimony from insiders filled gaps the spreadsheets could not. When charges were announced, they were broad and specific at the same time. Wire fraud, securities fraud, commodities fraud, conspiracy. The language was plain. The implications were severe. Sam Bankman-Fried was arrested and extradited to the United States. The founder, who had once spoken confidently about regulation, now stood in court as a defendant. The trial did not move quickly. It did not need to. Prosecutors laid out a narrative grounded in sequence. They avoided spectacle. They focused on mechanics, how money entered the system, how it moved, how it stayed longer than it should have. Witnesses described a culture of urgency without structure. Decisions made in private, risks accepted by default, boundaries assumed rather than enforced. The defense argued mismanagement, not malice. They pointed to rapid growth, market chaos, a founder overwhelmed by scale. They suggested mistakes compounded until control was lost. But intent in financial crime is often inferred from pattern. Jurors were shown repeated uses of customer funds, not one emergency, not one oversight, but a system that functioned only if prices rose and withdrawals stayed low. When the verdict came, it was decisive. Convictions established criminal responsibility. The court accepted that deception had occurred, that customers were misled, that funds were used in ways they had not agreed to. Sentencing followed months later. The judge spoke about scale, about harm measured not just in dollars but in trust, about thousands of customers who believed they were using a platform, not funding a hedge fund. The sentence reflected that view. Meanwhile, bankruptcy proceedings continued on a separate track. Teams worked to recover assets scattered across wallets, exchanges, and jurisdictions. Some funds were found, others were not. Customers filed claims, numbers were calculated, losses were formalized. For many, the outcome would never feel whole. The crypto industry watched closely, even when it pretended not to. Exchanges revised language, custody policies were emphasized, proof of reserves became a talking point, though often without uniform standards. Regulators pointed to the case as confirmation of long-held concerns. Innovation had moved faster than oversight. Offshore structures had created blind spots. Marketing had filled gaps where governance should have been. The lesson was not that crypto failed. It was that finance without enforced separation invites abuse. FTX had not collapsed because it was new. It collapsed because it violated rules older than markets themselves. Do not use customer money. Do not lie about risk. Do not confuse trust with permission. Those principles did not require new regulation. They required enforcement. In the aftermath, Bankman-Fried's public image vanished almost entirely. The altruist narrative collapsed under cross-examination. The genius framing dissolved into emails and spreadsheets. What remained was a cautionary figure, not uniquely evil, not uniquely reckless, but emblematic of what happens when systems reward speed and charisma over restraint. The industry moved on as industries do. New platforms launched, new tokens traded, new promises were made, but the reference point remained. When trust is centralized, failure is absolute. When rules are optional, consequences are not. The FTX collapse became a marker in financial history, a reminder that technology does not erase responsibility, that complexity does not excuse misuse. That belief, once broken, is expensive to rebuild. The reckoning did not restore what was lost. It clarified what had been misunderstood. Unregulated empire was never freedom. It was risk waiting for exposure.